We think of banks as these pillars of our economy, right? They're supposed to be symbols of stability, of permanence. But what happens when those pillars actually start to crumble? Well, the story of the world's biggest bank collapses isn't just a history lesson, it's really a blueprint of the massive fault lines hidden just beneath the surface of our entire financial system. Okay, let's dive in.
So, when I say financial crisis, what's the first name that pops into your head? For almost everyone, it's gotta be Lehman Brothers. But what if I told you the biggest failure of all was an institution that made Lehman look, well, kind of small in comparison? The largest bank collapse in history involved a firm with assets totaling in a mind-boggling $5.72 trillion when you adjust for inflation. Just to put that number in perspective for you, that is larger than the entire GDP of the United Kingdom at the time. It's just a staggering figure. And here it is. The biggest failure wasn't an American investment bank at all. It was the Royal Bank of Scotland. Its balance sheet was more than 6 times the size of Lehman's. Now that fact alone completely reframes the 2008 crisis, not as an American story, but as a truly transatlantic cataclysm. So, to really get our heads around how this all happened, here's how we're going to break it down. First, we're going to look at what I call the 2008 singularity. Then, we'll walk down the 3 roads to ruin that these banks took. We'll relive the exact moment the domino falls. Then look at the 3 very different government responses. And finally, we'll ask the big question, have the fault lines actually healed? Let's start with what might be the single most astonishing fact in this whole story, the sheer concentration of failure. I mean, all 5 of the biggest bank collapses in history didn't just happen in the same year. They happened within a few terrifying weeks of each other in 2008. Now take a look at this list. What's so interesting here is the geography. Look at the top 3. Royal Bank of Scotland from the UK, and then Fortis and Decia from Belgium, the Netherlands, and France. This just blows up the idea that this was purely an American subprime problem that spread. No, this was a global storm with massive independent epicenters right in the heart of Europe. So, how could so many giants fall basically all at once? Well, as it turns out, they were all weakened by pretty similar flaws, and they each took one of 3 very distinct paths to absolute disaster. We can really boil the primary causes down into 2 big categories. In Europe, the key problem was something we can call strategic hubris, basically a catastrophic failure of ambition. Over in the US, it was asset toxicity, building these massive empires on a foundation of fundamentally rotten loans. For RBS and Fortis, it all came down to one single deal, their acquisition of the Dutch bank ABN AMRO. It was an act of pure corporate arrogance. They massively overpaid. Right at the peak of the market, they didn't bother to properly check what toxic assets they were buying, and in doing so, they basically vaporized their own financial cushion right before the biggest financial storm in a century hit. Meanwhile, in the US, Washington Mutual had a totally different problem. Their internal culture was built around this motto, the power of yes. What did that mean? Well, loan officers were pushed to approve any and every mortgage they could, with very little concern for whether the borrower could ever pay it back. They weren't just participating in the housing bubble, they were a primary engine creating it. And then there was Dexia's path to ruin. On the surface, their business seemed, well, kind of boring. They gave out 30-year loans to cities and towns. But here was the fatal flaw. They funded these super long-term loans with very short-term money that had to be refinanced every single week. Their entire business model was built on a prayer that those funding markets would stay open forever. And in September of 2008, those prayers went unanswered. The funding markets slammed shut. And the trigger was the failure of one iconic firm, a failure that turned a bad crisis into a complete global meltdown. The collapse of Lehman Brothers unfolded with the speed and tension of a thriller movie. Over one single frantic weekend, regulators scrambled to find a buyer. First, a deal with Bank of America fell apart. Then, a last-minute rescue by Barclays looked like it might work, but it was vetoed by UK regulators who basically said, "No way are we importing America's problems." The clock had run out. In the early hours of Monday morning, it was over. Lehman Brothers, a 158-year-old titan of Wall Street, was officially bankrupt. And this wasn't an accident. It was a deliberate decision by regulators to draw a line in the sand and force the market to impose its own discipline. The consequence was immediate, and it was catastrophic. The web of credit that connects the entire global economy, the very system that lets companies pay their employees and their suppliers, it just stopped working. It froze solid.
The domino had fallen, and it was about to bring the whole structure down with it.
What happened next is fascinating because it reveals this deep split in philosophy. Faced with these collapsing giants, different governments chose starkly different paths. It was like a real-world test of what to do when a bank is too big to fail. Over in Europe, the response was basically overwhelming force. For RBS, Fortis, and Dexia, the #1 goal was to prevent the chaos from spreading, no matter the cost. This meant massive taxpayer-funded bailouts. In the case of RBS, the British government ended up taking an 84% ownership stake. The state essentially became the bank.
The US, of course, took the exact opposite approach with Lehman. The goal here was to avoid something called moral hazard. The idea that if you keep bailing out reckless firms, you just encourage more recklessness. So they let the market impose its ultimate discipline, bankruptcy. It was a principled stand with, as it turned out, disastrously underestimated consequences.
But for Washington Mutual, we saw a third way, a kind of surgical strike. The FDIC seized the bank overnight, made sure every single depositor was protected, and then sold the healthy parts to JP Chase. Shareholders got wiped out, but the banking system itself kept running without a widespread public panic.
So, after the biggest financial fire in modern history, the world rebuilt the system. The critical question, though, is, did we actually build it to be fireproof this time? Well, the single biggest change you can see right here on this chart. New global rules forced banks to hold vastly more capital. Think of it as a much bigger safety cushion to absorb losses. And by this measure, yes, the system is unquestionably stronger and more resilient than it was back in 2007. But, and there's always a but, as we saw in 2023, risk is like water. It always finds a new crack to seep through. The failures of Silicon Valley Bank and the others weren't caused by the old demons of bad mortgages. Nope, they were brought down by something different. Interest rate risk and, crucially, the first truly digital bank runs, where people pulled out billions of dollars in just a few hours using their phones. And this really leaves us with the critical challenge for today. The response to 2008 was to build higher walls, more capital, stricter rules. But the 2023 crisis showed us that panic now moves at the speed of light. So the question we're all left wrestling with is this: how do you regulate fear itself in an age where a bank run can happen with just the click of a button?